On Friday, Bank of America drops a headline that basically screams, "Silver is vastly overvalued." Then, days later, silver is sitting near fresh records while gold is blasting through $4,700. So the question is not, is silver risky? The question is, why would a major bank call it overvalued and in the same breath admit there's a path to $170? Because that is how shakeouts work. You don't shake people out with bad news. You shake people out with a contradiction. You put a carrot on the table and you slap their hand when they reach for it. So today, I'm going to show you the trap, the math, and the psychology behind it. Not to tell you what to buy, not to play hero, just to help you see the game board clearly while everyone else is staring at the dice. Disclaimer. Quick note, this is not financial advice. It's market commentary, education, and risk awareness. Know your situation, do your own research, and don't bet money you can't afford to lose. January 2nd, 2026. Reuters had spot silver around $71.77 after it had already tagged an all-time high of $83.62 earlier that week. January 15th, Reuters reports retail buying rushing into silver ETFs with nearly $922 million in net purchases over 30 days, and SLV seeing one of its biggest retail days since 2021. January 16th, Bank of America releases the note that calls silver vastly overvalued, pointing to fundamentals that justify closer to $60, while also floating a retail-driven path to $170 within 2 years. January 19th, Reuters prints the record run, silver around 94 plus, after touching a record high. Gold also hits records, with the Greenland Tariff dispute cited as a driver. January 20th, Reuters again, gold pushes past $4,700, silver hovers near a fresh record around $95. That's not a slow market, that's a market with a heartbeat you can hear through the walls. Bank of America's commodities strategist Michael Widmer put out a report on January 16th, 2026. In that report, they said silver is vastly overvalued versus traditional fundamentals, and they framed a justified price closer to $60 per ounce, investing.com India. But inside that same report, they also said, if retail demand stays on its current trajectory, silver could reach $170 per ounce within 2 years. Read that again. Overvalued and $170. That is not an accident. That is a psychological weapon. Because overvalued hits your fear brain. It triggers the part of you that remembers every time you bought a top. It reminds you of the moment you bragged to a friend and the chart dumped the next day. But the $170 number hits your greed brain. It creates a phantom future, a picture in your mind, a feeling. And when both fire at once, most people freeze. Then they do the one thing that feels like control. They sell. They take profits. They wait for a pullback. They get shaken out. When a bank says overvalued, it can mean one of two things. Meaning A, our model says this is above fair value. Meaning B, this is crowded and could pull back. And both can be true, while the long-term move is still up. Because fair value models are built on assumptions that behave in calm markets. They assume rational positioning, stable flows, predictable hedging. They assume the world is not waking up every morning to a new geopolitical headline. But in regime shifts, price is not a spreadsheet, price is a vote. So the real question is, are we in a normal market or a narrative market? Because Buffet itself is acknowledging narrative demand as a driver, retail treating silver as tangible money in a world of fiat anxiety and banking stress. That's their admission that the model world and the crowd world can diverge. And if you've ever watched crowds, you know something. Crowds don't move like equations, they move like weather. As of January 20th, 2026, gold traded above $4,700, hitting an all-time high around $4,731. Silver hovered just under a fresh record, too, around $95 an ounce. And the reason this matters is not just the number, it's what the number represents. Because silver didn't crawl to $95, it launched. Reuters notes silver rose 147% in 2025, supported by a structural market deficit and its designation as a U.S. critical mineral, and it has already gained sharply early in 2026. That's not normal commodity behavior, that's people repricing trust, and it's happening while the world is swallowing geopolitical stress like broken glass. In the last few days, the Greenland Tariff story has poured gasoline on safe haven demand. Reuters reports Trump threatened tariffs starting February 1st on goods from 8 European countries tied to the Greenland dispute. AP reports the same 8 countries and adds the escalation detail, 10% starting in February, rising to 25% on June 1st if no deal is in place. Whether you love that headline or hate it, the market hears one word: instability. And when instability rises, people run to things they can hold. Now let's talk about the ratio that doesn't trend on TikTok but moves portfolios. The gold to silver ratio, GSR, is simply gold price, silver price. Using Reuters prices from today, 4,227 D99, 95 June 34, 49.6. So yes, the ratio is basically sitting around 50.1. Why does that matter? Because when silver is truly in high beta mode, it doesn't just rise, it compresses the ratio. And historically, that compression can be violent. The 1980 low was around 14.1. 2011's extreme was around 32.1. I'm not saying we repeat those exact prints. History doesn't copy-paste, but it does rhyme, and it definitely mocks the people who think this time is normal. Now here's the math that makes people's eyes widen. If gold stayed at 4,728 and the ratio fell to 32.1, silver would be roughly 148 ounces. If the ratio fell to 14.1, silver would be roughly 338. That's not hype, that's division. And if you're wondering why you've seen the number $309 floating around online, at a gold price of about 4,326, a 14.1 ratio implies $309. So the 309 idea is basically the 14.1 historical extreme applied to a slightly lower gold print than today's. Why this looks like a shakeout? Okay, so where does Bank of America come in? Here's the pattern. 1. Retail piles in. 2. A respected institution drops a warning headline. 3. Price dips just enough to trigger panic and stop losses. 4. The same institutions quietly reposition. 5. The move resumes. 6. Everyone who sold spends the next month saying, I'll re-enter on a pullback, but the pullback was the trap. We're seeing retail participation in silver explode. Reuters cites a Vanda research report showing individual investors snapped up 921.8 million of silver-backed ETFs in the last 30 days, and the iShares Silver Trust saw one of the biggest single days of retail buying since 2021. That is not a little interest. That is a crowd forming at the same doorway. And when a crowd forms, institutions do what they always do. They test the floorboards. They don't stop the trend. They shake the tree. Because the goal is not to be right in public. The goal is to be positioned before the public. So when you hear vastly overvalued, ask, overvalued for who? Overvalued compared to what time frame? Overvalued for what objective? If you're trading a 20-minute candle, overvalued can matter. If you're watching a 2-year structural squeeze, overvalued can be noise. Research notes are not written for you. They're written for clients, and then they get chopped into headlines for the masses. A note can have 5 caveats, 3 scenarios, and 2 pages of it depends. But the public gets one line. Silver overvalued. That one line lands like a punch. Because humans don't react to nuance. We react to certainty. And if you want to understand shakeouts, you need to understand certainty. Because certainty is what triggers liquidation. People don't sell because they did math. People sell because they want the pain to stop. So if a headline can turn a confident holder into a nervous seller, that headline is a tool. Not always an evil tool. Not always a conspiracy. Sometimes it's just incentives. Sometimes it's accidental. But the impact is the same. It creates a window where fear is cheaper than logic. Let me explain exit liquidity like you're 5. Imagine a crowded theater. The movie is amazing. Everyone is leaning forward, totally locked in. Then someone behind you whispers, fire. Not a loud scream, a whisper, scream. Just enough to make 5 rows stand up. Now those 5 rows hit the aisle. The aisle clogs, people trip, panic spreads. And in the chaos, guess who gets the best seat in the theater? The person who didn't move. Not because they're braver, because they understand the whisper is sometimes part of the show. That's exit liquidity. It's when your panic becomes someone else's entry. And a shakeout is basically Wall Street engineering a whisper, a narrative jolt, a fast dip, a moment where your hands get weak. Let me translate what that $60 versus $170 contradiction really means. When Buffet says fundamentals justify $60, they're speaking the old language. Supply, demand, inventories, cost curves, macro models, regression bands. It's the language of normal. But when they say retail demand could drive $170, they're admitting something bigger. The market can move into a regime where fundamentals are not the driver. Narratives are. Trust is, and fear of fiat. In their own framing, Widmer highlights that persistent anxiety around fiat, the rise of crypto and stablecoins, and potential disruptions to banking systems can reinforce silver's appeal to retail investors as a tangible store of value. Investing.com, India. So the bank is basically saying, we don't like this price, but we respect the stampede. And if you've ever watched a stampede, you know something else. The most dangerous moment is not when it starts. It's when a loud noise makes the herd pivot for 3 seconds. That pivot is the shakeout. Now let's talk about the one detail the overvalued headline always skips: consumption. Gold is mostly stored. Silver is used. A huge portion of silver demand is industrial, electronics, solar, electrification, medical, defense. And a lot of that silver doesn't get recycled quickly or cheaply or at all. Reuters, citing the Silver Institute, has pointed out that silver is in its 5th consecutive year of market deficit. That matters because deficits are not opinions. Deficits are math plus time, and time is what turns a crowded trade into a shortage. Let's build a path to 170 that doesn't rely on wishful thinking. Step 1, start with gold. Reuters is already quoting major analysts targeting $5,000 gold. Whether or not that happens, the point is the market is now entertaining numbers that would have sounded insane not long ago. Step 2, pick a ratio. Not 14:1, not the fantasy print, just a believable compression from 50 toward the 30s. Here's a simple scenario map. Scenario 1, gold at $5,000, ratio $35.15 thousand, 35, 142.85. Scenario 2, gold at $5,000, ratio $30.15 thousand, $30, 166.66. Scenario 3, gold at $5,100, ratio $30.1, $5,100, $30, $170. See how little has to change? You don't need a 14.1 miracle. You just need gold staying elevated and silver doing what it historically does in late cycle moves. Outperform. That's why the $170 carat is powerful. It's not some moon math. It's gold is high and ratio compresses. Again, this is not a promise. It's a map of possibilities. This is the trap in one sentence. They make you compare today's price to yesterday's comfort. When silver goes from $72 to $95 in a few weeks, your brain doesn't process trend. It processes danger. It feels like you're late. It feels like you missed it. It feels like the next move must be down because your nervous system can't imagine up. So a bank headline saying overvalued gives your fear a certificate. Now you're not panicking, you're being responsible. But here's the brutal truth. Markets punish the need to feel responsible at the wrong moment, because responsibility in a shakeout often looks like selling the dip. Let me describe what it feels like when a crowd trade gets shaken. 1 hour, you're up. You feel smart. You're imagining the finish line. Then the chart prints a red candle so fast you think your app is glitching. Your stomach drops. Your fingers get sweaty. You open social media and the timeline is split. Half screaming crash, half screaming buy, and your brain is begging for someone to tell you what to do so you can stop feeling uncertain. That moment is the market squeezing your nervous system, because volatility is a weapon. It doesn't just move money, it moves psychology, and overvalued headlines land right in that gap. They don't create the dip. They justify your fear during the dip. Now, I need to be careful here because this is where people get reckless. I'm not telling you what form to buy. But I am telling you that even mainstream coverage is highlighting how much of this run is being powered by investor flow and safe haven behavior, not just industrial demand. Reuters. That means the market is being moved by liquidity, by positioning, by who wants exposure and who needs to cover. And when liquidity is the driver, you get gaps, squeezes, stop runs, and bizarre candles that look fake until you zoom out. So if your plan requires the market to be calm, your plan is already broken. If you want a clean authority table for the video, here it is. BOFA fundamental framing. Closer to $60, their justified value. Investing.com India. BOFA retail-driven scenario, $170 within 2 years if demand keeps up. Investing.com India. Retail flow signal, 921.8 menas into silver-backed ETFs over 30 days, Vonda via Reuters. Reuters. Price reality check, silver around $95 and gold above $4,700 on Jan 20, Reuters. Reuters. Structural backdrop, 5th consecutive year of silver market deficit, Silver Institute via Reuters. Reuters. Geopolitical spark, tariff threats tied to Greenland dispute, with Feb 1 start dates, Reuters, and a June 1st escalation described by AP. Reuters. Those aren't opinions. Those are the ingredients. Let's get practical. If silver is $95 today, $170 is not another 10%. It's almost a double. Moves like that don't feel smooth. They feel like whiplash. They come with intraday spikes that look fake, 2-day dips that feel like the end, headlines screaming bubble, your own family asking if you're gambling, people who never cared about silver suddenly caring. And here's the part nobody says out loud. If silver is going to $170, it will try to throw you off the ride multiple times. Because the market needs supply from weak hands to keep climbing. In every squeeze-like move, 3 groups get eliminated early. Group 1, the over-leveraged. They don't sell because they change their mind. They sell because they get margin called. Group 2, the impatient. They don't sell because they're wrong. They sell because they're tired. Group 3, the headline driven. They don't sell because they analyzed. They sell because someone with a big logo said a scary word. The market feeds on these groups the way fire feeds on oxygen. So if you recognize yourself in any of those, don't panic. Just realize the market is designed to punish that pattern. It's not personal, it's structural. Reuters notes markets expected the Fed to hold rates at its January 27-28 meeting, with cuts priced in later. And the Greenland Tariff timeline, as reported, puts a hard date on the calendar, February 1st, with escalation talk later in the year. Markets don't just move on facts, they move on deadlines. Deadlines create positioning. Positioning creates volatility. Volatility creates shakeouts. So if you want to understand why the tape feels like it's hunting stops, it's because it is. Let's demystify the shakeout without tinfoil hats. In a fast market, price doesn't fall because everyone decided to sell. Price falls because liquidity disappears for a moment. Most of the time, there are buyers and sellers layered at different levels, but when a crowd is leaning the same way, the market becomes a hallway. Narrow, echoey, slippery. Then one thing happens. A burst of sell orders hits a thin pocket, stops trigger, margin trims positions, options dealers hedge, and the move accelerates, not because the story changed, but because the microstructure did. That's why shakeouts feel like betrayal. Your brain expects a reason, but often the reason is mechanical. The market is searching for the level where real bids show up. And if you're wondering why this happens right after a headline, it's because headlines create synchronized behavior. They get thousands of people to react the same way within minutes. The market loves synchronized behavior. It can harvest it. Banks don't just publish research to predict the future, they publish research to manage client behavior. When price goes vertical, the bank has an incentive to warn clients about downside risk. Because if clients chase and get wrecked, relationships get wrecked. So overvalued can be a sincere warning and still function as a shakeout trigger. That's the ugly beauty of it. Intent doesn't change the outcome. You can have a well-meaning report that becomes a weapon once it hits a crowd. If silver is in a regime shift, the tape will look unstable. That doesn't mean the thesis is broken. It means the market is repricing the asset in real time. Think of it like a plane climbing through turbulence. The turbulence is not proof the plane is falling. It's proof the plane is changing altitude. But passengers don't feel altitude. They feel shaking, so they assume danger. Shakeouts are built on that human wiring. If you want something concrete to watch, here are 5 signals that are boring but powerful. 1. The ratio itself, GSR. Is it compressing over weeks or snapping back violently? The direction of the ratio often tells you more than any influencer. 2. Gold's posture above key psychological levels, not because it's magic, but because gold acts like gravity for the whole complex. 3. Retail flow persistence. One big day is noise. 30 days of accumulation is a story. Reuters. 4. The policy headline frequency. When the news cycle turns into a drumbeat, safe haven demand can stay sticky. Tariff deadlines are part of that drumbeat. Reuters. 5. Your own behavior. Yes, I'm serious. If you're checking the chart every 10 minutes, you're not investing. You're self-harm scrolling. Your nervous system is a signal. When you feel compelled to act, that's often the market pushing your buttons. On one side is $60 fair value. On the other side is 170 crowd value. And in the middle is a wind tunnel. Most people step onto the bridge, feel the wind, and run back. They don't run back because the bridge is collapsing. They run back because the wind makes them imagine it. The bank report is the wind. The headline is the gust. The dip is the wobble. And somewhere underneath, the river is the same river. Deficits, demand, trust, and time. If you're watching this because you already have exposure and your heart is pounding, here's the honest truth. The market will keep trying to turn your attention into a weapon against you. So use rules. Rule 1. Size like an adult. If a 5% move changes your mood, your size is too big. Cutting size is not giving up. It's buying emotional endurance. Rule 2. Don't borrow confidence. Leverage feels like conviction until the market hiccups. Then it becomes a forced liquidation machine. Rule 3. Stop letting the close decide your identity. A red day doesn't mean you're dumb. A green day doesn't mean you're a genius. It means the market moved. Rule 4. Write your thesis in 1 paragraph. If you can't explain why you're in the trade without mentioning today's candle, you're not in a thesis. You're in a mood swing. Rule 5. Remember what $170 actually implies. It implies chaos. It implies headlines. It implies your friends will suddenly care. It implies the market will try to throw you off the ride repeatedly. So don't treat the ride like a straight road. Treat it like a stormy ocean. You don't win storms by yelling at the waves. You win by steering and staying afloat. Could Buffet be right about a pullback? Absolutely. Even the strongest uptrends breathe. But the trap is thinking a pullback equals the end. A shakeout isn't a verdict, it's a transfer. From the panicked to the patient, from the leveraged to the funded, from the short term to the long term. And that is exactly why the word overvalued shows up right when the crowd is loudest. Let me give you a battle plan that isn't hype. 1. Decide what game you're playing. Are you trading candles or holding a thesis? If you're trading, accept you can get clipped. If you're holding, stop staring at every tick like it's a verdict. 2. Define your risk before the market defines it for you. What would make you exit? Not a red day, a real thesis break. 3. Respect volatility. If you can't emotionally survive a 10% dump, you don't own the position. The position owns you. 4. Watch the ratio, not the noise. If gold is steady and the ratio is compressing, silver strength is real. If the ratio expands while headlines scream bullish, be cautious. 5. Separate price from liquidity. The market can gap, it can flash crash, it can overshoot. That doesn't mean the story is dead, it means the market is harvesting emotions. 6. Don't worship targets. $170 is not destiny. It's a scenario, a reference point, a carrot. Use it to map possibilities, not to surrender your judgment. 7. Don't confuse being early with being wrong. In violent markets, you can be right and still feel stupid for weeks. That's normal. Here's my read, and I'm saying this as clearly as I can. Bank of America is not accidentally contradicting itself. They're describing two worlds at once. World A, the model world, the world where silver should be $60. World B, the crowd world. The world where retail demand, fiat anxiety, and safe haven flows can push silver toward $170, maybe higher, if the ratio keeps compressing and gold stays elevated. Investing.com, India. And the space between those worlds is where the shakeout lives. Because when institutions want better positioning, they don't tell you, hey, we'd like a better entry. They tell you, be careful, it's overvalued. If silver is going to do something historic, it will not feel comfortable, it will not feel polite. It will feel like a test of patience, a test of conviction, a test of whether you can separate information from manipulation. The market doesn't steal from you with force. It steals from you with emotion. So the next time you see overvalued in big letters, ask, is this warning for my safety? Or is it a headline designed to buy my panic at a discount? If you want more updates like this, hit subscribe because this story is moving fast and the details matter. And in the comments, tell me one thing. Do you think $170 is a realistic 2-year target? Or is that the carrot that keeps the herd running?